We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Jim Welsh, founder and publisher of Macro Tides with over 40 years experience of investing and portfolio management. How are you today, Jim?
I'm good, Tom. How you doing?
I'm excellent. It's a wonderful day here, kind of mid-November, and looking forward to chatting with you again. It's been a while since we've had you on the show, but looking forward to digging into some of this stuff here with you.
Hey, glad to be here.
So, Jim, yesterday, of course, we had the CPI revised figure, or the CPI for, I guess it would be October now, come out.
Yep.
And, it made the markets react very bullishly. There was a lot of stuff that ended the day green, had some major runs yesterday. And this seems very typical of, this behavior, this reaction that Wall Street seems to have to numbers like this. So how do you, see that lens, let's say, what Powell has been saying versus what the market's reaction to reporting these numbers is?
Yeah. Well, what's happened, Tom, really over the last year and a half, as we've gone through the interest rate hiking cycle, is people have almost totally fixated on inflation. And it's understandable because inflation shot up to 9.1% in June of 2022, the highest in 40 years. That obviously elicited a very strong response by the Fed in terms of raising the funds rate of 500 basis points. So it's understandable that there's this fixation on it, but it isn't the whole picture. Mm-hmm. And so to me, the reaction that we've seen last year, it was expectations that the Fed was going to stop raising rates, sooner than they actually did. And now the idea is that, with the inflation down like this, they'll be able to cut rates sooner. And so the Fed funds futures are looking at a 25% probability that the Fed will cut the funds rate in March of next year, 65% probability for May. And I just think that's unrealistic based on all the speeches that Powell has made, where he has consistently cited a number of points. One has been, we don't want to make the mistakes of the 1970s, and we can talk about that in a second, what those mistakes were and why that experience is guiding policy at this point in time, and also the role of economic growth as measured by GDP and the unemployment rate. So there are parameters beyond inflation, Tom, that the Fed is relying on and which will guide monetary policy over the next 12 to 18 months. And I think Wall Street is being a little myopic in terms of just focusing on inflation and believing that that is the key determinant of how the Fed's going to proceed.
Mm-hmm. Well, I think there's that recency bias that everybody is kind of stuck to, and it's going to take some time to kind of learn that lesson, I think. It's interesting, you made a point in your latest technical review of the lag time and the reason for the lag time between the Fed moving to a restrictive policy to when a recession actually begins. So if you could expand on that explanation for us, Jim.
Yeah, the yield curve inverted in July of 2022. Mm-hmm. So historically, it's been a very reliable predictor of recessions. You go back into the 1950s, and there's really not a miss. All right. The problem for most people is they read that part of the story, but they don't pay attention to the fact that the average lead time is 19 months. So there's been times where it's like 6 to 8 months, and there's been times it's 27 months. But on average, I think it's 8 or 9 recessions, 19 months. So given that we know that consumers exited the pandemic with a lot of savings, because the government distributed a lot of money for a period of time, they couldn't go out and do things. So there was over $2 trillion worth of excess savings that they've been slowly depleting. Well, that to me increased the probability that, that 19-month average, seemed reasonable. So you take 19 months from July of 2022, and you're basically January of 24. Lending standards going up aggressively. So the Fed hasn't been doing much with interest rates, but banks over the last year have increased lending standards significantly. And what that means for small businesses is the cost of money is obviously gone up a lot because of the Fed rate increases. Banks then add, if you will, an additional charge for small businesses. The spread gets widened out. And then the other thing, Tom, is, if I have a credit line with my bank, they may shrink that credit line. So if I have a loan that I took out towards the end of 2022, that loan is just coming due now, where I'm going to feel the full brunt of all the rate increases and so forth. So the lead time on lending standards is about 13 months, which, lo and behold, if you take 13 months from the fourth quarter of last year, we're in that window of time now. So to me, those are some of the reasons why I think people have kind of been hoodwinked, in the sense that, we had 2 negative quarters of GDP in the first 2 quarters of 2022. The yield curve inverted. Oh my God, we may already be in a recession last year, or then after the regional bank crisis. Well, it hasn't happened yet, but now it definitely is going to happen. And the irony is that because they had these expectations for recession to happen, which were wrong, and I wrote about this extensively throughout the second half of 2022 and obviously the first half of this year, they're set up now to be surprised again, in the sense that I think these long lead time indicators are likely going to be correct, in the sense that we're going to see, I think, a significant slowing in the economy with at least 1 negative quarter of GDP between now and, let's say, the middle of next year. So the lag time concept just wasn't fully focused on or understood, which led to what were incorrect expectations for a recession last year. And now I think they're setting up people to be blindsided, since we're just entering that window when some of these things are going to, if you will, provide the biggest brunt of slowing on the economy. And there's a lot of other signs of slowing, in terms of, people relying more on credit cards. Well, that signifies, the excess savings for some people have certainly already run down. The savings rate has dropped from 5.3 in May of this year to 3.4, way below where it was prior to the pandemic. So there's signs that, delinquency rates are higher now in a number of age categories than back in 2019.
And,
so
and climbing aggressively.
I'm sorry?
And climbing aggressively.
Yeah, I mean, the angle is like this. So there's signs of stress that have been building and increasing. But because GDP was up 4.9% in the third quarter, anybody who thinks a recession is coming is out of their mind. Now, what I wrote about after that report, Tom, was if you went back to 2007, the third quarter of 2007 was up, can you believe this? 4.9%. I mean, it's like sometimes the universe is having a joke on us, right? So the same thing happened in 2007. People weren't looking for a recession. And, obviously much worse than a recession showed up in 2008. So those are the reasons why I think people are poised to get fooled again, as the Who used to say, don't get fooled again, or whatever their song was. I think they're going to get fooled again, and that things are going to slow materially over the next 6 to 9 months.
I think it's interesting to think about the actual mechanisms that end up tightening financial conditions versus just looking at the headline rate. Like it's not just the headline rate and raising, as aggressively as the Fed has to get to that let's just call it 5.5% level.
Yeah.
That absolutely is a scary number when you're coming from the zero bound, really. However, looking at the actual mechanisms that restrict economic activity, I think is a really important point to understand, because that's where the rubber actually meets the road, right?
You're 100% right. It's like what's happening in the real world. And so for a lot of reasons, there is always a built-in delay factor. The excess savings that people had, plus wage growth was the best it's been in a few decades. Unemployment, 50-year lows. Those are all other factors. Oh, Social Security in January of 2023, an 8.7% increase. So you had, I think, 26 states at the beginning of this year increased their minimum wage. So consumers were bolstered by some of these other factors, but slowly but surely, what you're talking about, the real world drag that happens when you see big increases in the policy rate, slowly but surely, the weakest hands get affected first. And then slowly it works up the income ladder, if you will, and affects more and more people. The same thing is happening with corporate bankruptcies. We've more corporate bankruptcies in the first 10 months of this year than since 2010. Well, wait a second. The economy is growing, almost 3% a year so far this year. And yet corporate bankruptcies are hitting a 12, 13-year high. So what we're seeing is under the surface, underneath of that 4.9% GDP that gave a lot of people, conviction. Oh, I don't have to worry about a recession anymore. But underneath, there's rot. And it's slowly but surely spreading. And when the economy slows, historically what happens, Tom, is, the weakest hands get hit first. But when revenue growth starts to slow, more and more small companies are really going to face a squeeze on cash flow. And ultimately, they wind up laying more people off. So the labor market is a lagging indicator. Why? Well, because companies have, experienced people and they don't want to let them go. So they cut back overtime. They, let go of temporary help. All right. So what we've seen is already a pronounced decline in temporary workers going on 6-8 months. Hours worked has dropped significantly. Overtime hours have dropped. So companies are already responding to try to minimize labor costs. And then you get to the point where revenue slows enough, but then you got to start laying people off. And given the difficulty that many companies face to find good people, over the last 2 years, hiring people, finding people was so tough, that inclination to hang on is probably going to be stronger this cycle than in prior cycles. But at some point in time, as you said, rubber meets the road. I'm running a small business. I got 15 employees. I got to let one or two go because you know what? The numbers aren't working for me anymore. I owe so much in interest every month. My rent for my space went up a lot. Insurance costs have gone up significantly. So those are all the things that, again, gets to the point of it takes time for all these things to reach a critical mass and cause a change in behavior. And I think that's what we're going to see in the next 6 to 9 months.
Well, the point you make about GDP being this spectacular number is interesting as well, because you just brought up a bunch of points about this inflationary growth in a way that we've seen. So it could be that we're not actually growing the economy. However, just the nominal price level of everything has gone up, which doesn't mean the economy is actually growing and gathering speed. Rather, it's just the price level that is offsetting, that dollar amount, right?
Yeah. And I think consumer spending in the third quarter, which is 70% of GDP almost, was up 2.8% or contributed 2.8% to the 4.9%. So more than half of it. And we just went through a reason why we're likely to see consumer spending retrench. The other thing was inventories. So companies added to inventories, which I think added 1.2%. Well, what happened in a slowdown? We just had this strong period of growth. Hey, we better get some more stuff on the shelves. Then growth slows. What happens next? They cut back on orders. So, again, these are all like dominoes that slowly but surely tumble. And I think the table is set for a lot of these things to fall into place and cause the economy to slow materially in the next 6 to 9 months.
Well, Jim, you were gracious enough to send me a bunch of charts here.
Hey, Tom, one thing, last point, because it's kind of important regarding monetary policy, because As I said, there's this fixation on inflation. But Powell, in many, many speeches, and a number of other Fed governors have talked about, we want to avoid the mistakes of the 1970s. So I think they have a clear understanding of what really is guiding the Fed beyond just the CPI numbers, is what were the mistakes of the 1970s? Well, as inflation started to tick higher, I think in the beginning of 1965, what the Fed did was aggressively raise rates in 69, and it caused a recession. They did the same thing 73, 74. So the first mistake was we don't want to be overly aggressive in raising rates so that we tip the economy into a recession. So that's why you keep hearing them talk about, we're slowing the glide path. We have gaps between rate increases. We've gone from 75 to 50 to 25, skipping a few months. So they're trying to nudge it without being too aggressive. And that's why I think, is the Fed going to raise rates more? I don't think so, and haven't thought so. The second mistake, obviously, was, okay, because we kicked off a recession, we then had to cut rates aggressively. And what that meant was the economy got stimulated before enough excess capacity was created in both production and the labor market. So Powell has repeatedly said, Tom, and I mean, every single speech, okay, that he's looking for GDP growth to slow below trend. Well, what's its long-term trend in terms of the Fed's perspective is 1.8%. We haven't had a single quarter below 1.8%. Secondly, they projected unemployment to get to at least 4.1. I think behind the scenes it's higher, but politically that's not a good number. So that, why are they thinking like this? Well, at the point in time when the economy meets those criteria, it's slowed enough for a period of time, unemployment's ticked higher, okay, now we're going to raise rates. Well, they want this to evolve so that when they do cut rates and the economy begins the next expansion, we're not running into a ceiling in terms of capacity utilization. Well, all of a sudden, companies can raise prices quickly again. Labor market tightens too quickly. Wages are going up. So that, to me, is the perspective that Powell has repeatedly talked about, that Wall Street has completely neglected or overlooked, and that I think it's a big determinant in terms of policy. Powell has said a number of times it would be a big mistake to ease policy prematurely. So the idea that Wall Street is gaming idea, well, they're going to cut rates maybe in March, for sure in May, doesn't jive with the statements that Powell has made. And so to me, that's when opportunities are created. Because markets like to believe, or Wall Street likes to believe, markets discount the future. Well, the reality is they get it wrong a lot of the time. In late 2021 and early 22, Wall Street was looking for 3 rate increases in all of 2022. I mean, that was Goldman Sachs's projection. In January of 2022, I wrote, hey, Powell just said that inflation is an extreme threat. Well, how do you respond to an extreme threat? You don't respond nonchalantly with 3 rate increases over 12 months. And I believe that the Fed was going to front load rate increases, and it surprised everybody because in March, May, and June of last year, that's exactly what they did. So opportunities are created when Wall Street thinks of something is going to happen, and they're wrong. And so to me, there's enough evidence based on what Powell has said repeatedly over the last 18 months that doesn't jive with the idea that the Fed is going to be cutting rates in the first half of next year just because inflation is down. No, they're looking at capacity utilization, which has been running above 79%. Historically, it gets closer to 76% or lower. So that to me is one of the guideposts in terms of, well, is there enough slack in the overall economy so that companies aren't raising prices in the early phases of the next expansion, and then obviously the unemployment rate. So to me, that's the kind of insight I try to provide, is a better, I think, a deeper understanding of monetary policy, and then comparing it to what are the expectations out there. And when they don't mix, as I said, that's what creates opportunities.
What do you think brings the Fed to the next rate cut? Is it them reacting to a certain crisis? Is it the recognition that they feel like they've done enough because they have, several quarters worth of data that is showing that inflation is staying, let's say close to their 2% target? Do they raise that target? How do you see all that?
Well, the Fed is always going to respond to a crisis, Tom. I mean, the regional banking crisis, they didn't cut rates or anything, but they did, put
stuff that hole with paper.
Yeah. Okay.
In a
so
way,
that's their mandate, lender of last resort. Okay. So if there's a crisis that has a potential to really depress the economic activity, they're going to respond to that. So the other scenario is that, all right, we get a proverbial soft landing. The economy slows over a period of 6 to 9 months. Growth is like 1% or so. Inflation is down even more. Labor, that they really have confidence. That's the word that many of the Fed governors, including Powell, have said repeatedly. We have to have confidence that inflation not only is trending toward our target, but will stay down. And I've just spelled out two of the reasons, or determinants of that confidence building. And then the last thing is, of course, guess what? The economy slows more than expected. Things like commercial real estate, that's a big problem. I think there's $1.5 trillion over the next 2 years coming due. It's going to be tough to roll over a lot of that paper. Landlords are going to give the keys. When the economy slows, things happen. And so to me, that would be the third reason. Now, is Wall Street going to respond, like in terms of the stock market, will it respond well to some kind of a crisis? No. Will it respond if the economy slows enough to force the Fed to cut rates because it's slowing so much? I don't think so. So right now, Wall Street is betting on we're going to get the perfect outcome. Things are going to slow, but not too much. Earnings are going to grow, and inflation is going to come down, and everything is perfect. That's where Wall Street is at. And if we look at history, the probabilities of that, based on the largest increase in the funds rate in 40 years, the largest and fastest increase in lending standards in 40 years, is like, that isn't going to have a meaningful impact. And then you look at the leading economic indicators, which have been down 18 months in a row. It's another indicator going back 50, 60 years, where when it gets this weak, you've had a recession. So, I'm just going based on the indicators that historically have had almost a perfect record, with the understanding that this time, these lead times just got stretched out because of the special circumstances of the pandemic.
I think that's a great way to summarize it, Jim. And really, that we're not expecting this time to be different, right?
Yeah. I mean, one of the reasons why, people last year were like, oh, yeah, another reason we're having a recession is because look at ISM manufacturing is negative. New orders were declining like last October. Well, what I wrote was, wait a second, folks. What happened? When everybody was locked up in their houses, they went nuts buying stuff, goods. So we saw this huge spike in demand for goods. Well, once the economy reopened, I don't need no thinking stuff. I want to go out to dinner. I want to go to a movie. I want to go to a concert. I'm going to go travel. And so the demand for goods dropped significantly, but the increase of spending on services made up easily for the difference. Why? Because services are 80% of GDP and goods are about 12%. So my point is, people were looking historically, because if you went back the last 50, 60 years, whenever ISM manufacturing went below 50, you had a recession, without thinking about, well, what's happening in the world right now. And, but that's, again, the kind of insights I try to provide by looking under the surface. And, it's been very helpful to kind of combine fundamental analysis and technical analysis. Just winds up giving me a stronger conviction on what I expect to happen. So.
Perfect. Ready to move to the charts, Jim?
Let's go to the charts.
Okay.
So one of the things I've been writing about, well, the recession whipsaw, that's what we talked about earlier, that now everybody doesn't think a recession is coming. just in time for at least a material slowdown. If you want to skip ahead, Tom, to I think chart number 3, the second chart, and if anybody wants this deck of charts, send an email to me, jimwelshmacro@gmail. I'm happy to send this presentation to you, as well as the first slide showed. I have a special report called The Coming Secular Bear Market. There's a lot of these charts in there, plus a lot more. Okay, so this is a chart of the 10-year Treasury yield. And what we can see is, at the bottom there, 1945 is when it made a low, 46 in that time period. And then it went up for 35 years to 1981. So you had this long secular bear market in Treasury yields. And then that was followed by a longer secular bull market from 1981 to 2020. So these secular trends in Treasury yields, for whatever reason, appear to have long life attached to them. And there are a lot of reasons why I think we very likely have entered in another secular bear market. And the next chart, I think, will kind of make that more readily available.
Jim, as we're touching on
any question, Tom, just jump in, please.
As we're touching on the Treasury market here, of course, I think it was at the beginning of this week, they had a disastrous Treasury auction, right?
Yep.
So
last Thursday.
Okay. Yeah. So the end of last week.
Yep.
So do you think that starts to spell out trouble for the Treasury market, or do you think that was more so an artifact of the trouble that I believe it was that China had with that, whatever they called that cyber attack?
Yeah, I mean, the cyber attack thing probably played a role for the magnitude of it, but the overall concept of we just finished the fiscal year ended September 30th. The government works on a September 30 fiscal, $1.7 trillion deficit. That's with GDP growing almost 3%. We've never had a deficit that large outside of a recession. The next year, I think about it's like a huge amount of money coming in terms of how much they're going to have to refinance. So the amount of supply in coming years is going to increase for a number of reasons. Interest expense is consuming a higher proportion. The Congressional Budget Office has said that by 2033, interest could be 1.4 trillion every year, which is kind of unimaginable. But we've gone from a $20 trillion deficit in 2019 to 33 trillion, and we're heading up very aggressively. So the issue, Tom, of supply, I think, is going to return. And if I'm right, and we get a recession, you're talking $3 to $4 trillion deficit. So supply is going to be, I think, it's one of the reasons why the idea of a secular bear market makes some sense, because the aging of America, the increase in spending for Social Security and Medicare and other support programs under the mandatory spending, those have to be addressed and cut back. And there is zero political will to do it. So, that is one of the components of why that goes into the column of, are we likely in a secular bear market for bonds where yields will be higher for longer? Check mark. A lot of debt and a lot of funding.
Not only zero political will, but also zero political incentive at this point. Really?
Well, most people are oblivious, unfortunately, to a lot of this information. They're working hard. They're living their life. They're trying to take care of families and everything else. They were never taught this. You can graduate from college and never get a single economics class. So there's a lot of illiteracy out there when it comes to this stuff. Okay, this is a chart of the 30-year Treasury bond. And what you can see in the bottom left-hand corner, yields peaked about 1981, over 15%, and bond prices kept working their way up and up and up. You got this really beautiful trend line, and that has been violated, not by a lot, or by little, but by a lot. So that's, to me, confirmation that this uptrend that lasted 35 years is over. All right. The other thing that you'll notice on that chart, if you look from the high in 2020, you can see 1 down, a little bounce for 2, where that arrow is pointing to. 3 took it through the trend line, which is classic charting analysis, where wave 3 is the strongest move. A little bounce for 4, and then 5 down. So that's another the way I analyze markets is looking at price patterns as well. And 5 down basically is an indication that the primary direction now is down. Now, 5 down also means you're going to get a rally, which I think the next chart addresses. Okay, yield curve inversion. We talked about the yield curve inverting, 19-month lead time. Well, what typically happens, Tom, is we get more signs that the economy is slowing. People start to anticipate, well, you know what? The Fed will actually be cutting rates. Right now, I think they're obviously way too optimistic about that. But what starts to happen is the 2-year Treasury yield is anchored. In this case, I think it's the 3-month T-bill. It's pretty much anchored with the Fed funds rate. But what happens when people start to think that the economy is really going to slow? The 10-year yield comes down. So let me back up for 1 second. A positive yield curve is when short-term rates are lower than long-term rates. That's a normal yield curve. It inverts when the short-term rates go above the longer-term rates. So what happens when we start to get the idea of a recession is the long rates start to come down and uninvert the curve. And whenever that has happened, where the curve is narrowed by 100 basis points or 1%, you've been that much closer to a recession. And those arrows show those experiences when the long rate has come down. And we recently, in mid-October, got one of those signals. So the spread went from 80 basis points to 30. I mean, it was so that is another sign that we're getting closer, in my mind, to the onset of a meaningful slowdown in the economy. Again, at a time when most people aren't looking for a slowdown. Oh, I mentioned this earlier, leading economic indicators. It's a composite of 10 separate indicators, so it's pretty broad-based. And what we can see, 18 months in a row that it's been down. This goes back to like 1960. You can see every other time it's had 9, 12, whatever. We've had a recession. So again, to me, the fact that it hasn't happened doesn't mean this indicator is no good anymore. There's special reasons why it's taking longer. But I think the message should be understood and respected.
Well, you can see in 2004, 2005 there, it spiked up, but without having, going into recession, right?
For a long time, for a fair amount of time.
8 months, yeah.
Yep. So it, again, this is just one more reason why I think we're on the cusp of a significant slowing. Okay, I mentioned this earlier. The left-hand side shows going back, I think, the recent last 30 years or so, all the way back to the 80s, it looks like. So a little bit longer rate increases. So we can see that the current cycle, the Fed has increased the funds rate to a higher rate of increase, but also faster. So to me, again, what you were talking about earlier, rubber meeting the road, the idea that we're not going to have any kind of a real impact or drag from these increases, to me, just doesn't seem realistic. And then the lending standards, which a lot of people don't put a whole lot of attention on, Tom, and I think it's a big mistake, is look, you can see how much lending standards have been increased in this cycle compared to all the other cycles. So, small and medium-sized businesses pretty much are totally reliant on banks for lending. Big companies can issue bonds in the public market. Small and medium-sized businesses don't have that luxury. So sooner or later, it winds up, as I talked about earlier, we'll start to see small businesses, which imply more than half the people in the country, are forced then to start to lay off people. All right. In March of last year, when the Fed initiated rate increases, Powell gave a speech and said, I think we can do a soft landing. And he cited 3 examples, 1965, 1984, 1995. And those were all 3 times where the Fed increased the funds rate by a significant amount, and we didn't have a recession. The one thing he didn't mention was the role of lending standards. And in those three tightening periods, lending standards weren't tightened significantly like they have been during this cycle. So to me, this blows out of the water the idea that we're going to have a soft landing, because anyone who cites, oh yeah, well, Powell said it, and it happened there in 1965 and 84 and 95. Yes, it did, except this is a different environment. So another reason why the odds of a significant slowing / recession, again, the role of lending standards are a big deal. Okay, so when we looked at the 30-year bond price, well, TLT is the ETF that mimics the trading direction and moves in the 30-year bond. And what we can see from March of 2020, TLT peaked at 179.70. And you can see the numbers marked in red: 1 down, 2 up, then a 1, 2, 3, 4, 5 for 3. The rebound to 109 in April for 4. And then we've completed, I think, wave 5. So as I said before, this pattern suggests the major trend is down in Treasury bond prices. But because we got 5 down, it's time for a retracement move that I think can bring TLT back to the 105, 109 level. Also, it's just completed 5 waves up. So that tells us that the intermediate trend is for yields to come down. Well, what could cause a significant drop in Treasury yields? How about the economy slowing materially? Mm-hmm. And so to me, you asked a great question earlier about the supply. So to me, what's shaping up here, Tom, if you got 5 down, okay, the major trend is down. Now we're going to see a significant rebound. Why? Because the economy is going to slow materially. And then at some point in time, next summerish, maybe, that decline in Treasury yields is going to end. And then the avalanche of supply that's going to be coming in response to this recession is going to start to overwhelm the bond market. And foreigners have already been cutting back, not just China, across the board. The amount of foreign buying has, in fact, decreased. And if you see the political incompetence in Washington, it doesn't inspire people to think, okay, they're actually going to address this problem. So again, to me, this suggests we have 5 down. We're going to get a pretty nice rally because of a slowdown in the economy. And then we're going to be overwhelmed by supply. And that ultimately Treasury yields are going to rise more and take out these highs that we've seen with the 10-year getting up to about 5%. The other thing I'll point out, 179 to 82, that's a decline of 54%. Imagine if the stock market declined by 54%. So banks are holding a lot of Treasury paper. They got a lot of paper losses. So that inhibits, I think, their ability to be aggressive lenders going forward. So anyway, okay, dollar last year in June of 2021, Powell was saying inflation was going to be transitory. I was writing, nope, it's not going to be transitory. I thought that the dollar then would rally from, at that point in time, it was around 90 to 100, just based on the pattern and so forth. And in fact, it rallied beyond that to 114. Last October, to me, the pattern, the rally looked complete. I thought we would see a decline to under 105. And as the dollar declined, I thought we'd see the bond market rally, gold rally, stocks rally. Why? Because as the dollar went up last year, all those other markets went down. In July of this year, Tom, when you can see A, B, C, D, E, that pattern suggested a triangle, and we were going to see a plunge. And as you might remember, in July of a few months ago, well, the dollar is going to lose its reserve status. And I mean, they were all over the place with that. I looked at it and said, nope, I think we're about to see a rally to at least 104. So where we are right now is, I think from the high at 107.34, we've completed an ABC or close to doing that. And then I think there's a good chance we'll see one more rally that takes the dollar above 107.34. Is it going to be because of something happening in the Middle East? That's obviously a real possibility. Or all of a sudden we get data that shows, gee, the economy isn't quite ready to roll over, and people reassess the idea of what the Fed is going to do. But that's what the pattern to me implies. One more rally. If I'm right about the economy slowing materially, Tom, just as it strengthened based on economic strength, I think we're going to see a significant decline in the dollar. And the obvious cause, it should go back to the lows that we saw last July, under 100.
Mm-hmm.
So obviously that has implications for other markets. Once the dollar confirms that it has indeed made this secondary top, it opens the door, I think, for gold.
Mm-hmm. Well, to that point, Jim, if the rest of the world is slowing as well, and we're not, or the demand for dollars is not coming strongly for economic growth abroad, I think that is another confirmation to what you're saying here.
Yeah, exactly. Plus, what's helped the dollar is Europe is already in a recession, or certainly on the cusp.
Mm-hmm.
So, the U.S. growth has been much better than other developed countries.
Just as a comparison, right? And Japan as well, because they're having to sacrifice the yen to, deal with their bond market.
Right. So, again, when it becomes obvious that the U.S. economy is in fact going to slow materially, I just think the probabilities are we're going to see the dollar weaken, and what it implies is, just based on the chart, a decline under 100 is likely. Mm-hmm. So we might have one more pop going into year end. A lot of times currencies, the dollar at least, has a tendency to, reach inflection points early in a year. Mm-hmm. And so to me, there's the potential that we'll see the dollar have this one more pop. But after that, I think a decent decline is going to create opportunities. And one of those opportunities is gold. So what you can see is from the low in October of last year, you can see 1, 2, 3, 4, 5. Mm-hmm. To me, that's very significant. Again, it implies that the major trend in gold is up. And in May, I was looking for the dollar to have a correction, because after you get a 5-wave move, you're going to get a retracement. And I thought ultimately that we would drop below 1850. Gold got down to 1812. We've seen this strong pop up. I think that's wave one of the wave that's going to take gold to new all-time highs. So we're in this pullback that I think can take gold below 1933. If I'm right about the dollar having one more pop, mm-hmm. you get another pullback in gold. But if I'm right about the dollar weakening next year, Tom, gold is going to finally take out that triple top between 2050, 2070. And I think, 2,300 becomes very likely, mm-hmm. maybe even higher, So
well, I think especially the measured move, let's say, is, something that you can kind of get your hands around. I think the difficult part is to account for the amount of momentum that comes in because of that, number yes. that everybody sees, and how much of that capital becomes free and rebalances into that market, right?
You're 100%. And, technically, most people don't pay attention to charts and technical analysis, but if gold gets above 2070 and it has a head of steam, you're going to see, a lot of hey, gold just broke out. Oh my God, look at this. And oh my, look at how much is up. Hey, everything else is not doing so great, but the gold, hey, I gotta be in gold, And I assume if you're short this market, do you think gold's going to go down because of a recession without taking into account what might happen with the dollar? Mm-hmm. Well, where are you going to put a stop? I mean, your drop dead spot has to be at 2070, Mm-hmm. So to me, this is the one market that I think has a lot of potential next year. The only caveat is if we get some kind of a real financial crisis, what happens is everything gets sold. Because in a financial crisis, cash flow and cash gets depleted, and it's like you sell what you can. And we've seen it in 2008, gold popped and then it got hammered.
Mhm.
So that's the only caveat. But based on what the charts look like, the fundamentals look like, I think gold is going to have a pretty good year next year. Things are set up finally for a breakout. And I think the probability of that happening is pretty high. Okay, correlation between stocks and bonds. This is really important because 60-40 allocation is like gold. 60% stocks, 40% bonds. So what this shows is going back to 1945. Historically, stocks and bonds moved together. Yeah, there were some times in the 50s and 60s for brief periods where they went opposite. Okay, fine. But on balance, you can see most of the time they moved together. Then when the Fed adopted negative real rates, we see that the correlation changed. So in 2001 and 2 and in the financial crisis, if you had government bonds in your portfolio, yeah, stocks went down 50%. They went down 57% in the financial crisis, but treasury bonds rallied like crazy. So wow, that 60-40 paid off. In June of 2021, when I said inflation wasn't going to be transitory, I discussed the correlation between bonds and stocks. My conclusion was we were about to revert back to the historical norm of bonds and stocks moving together. What happened in 2022? It was the worst year in decades for the 60-40 allocation. So if I'm right about the treasury market is going to, yields are in a secular bear market, higher for longer, it's going to have an impact on equity prices. I think that increases the odds that the stock market is also on the cusp or has already begun a secular bear market of its own that could last 10, 15 years or longer. So this is a big deal, what this chart is showing, because it shows kind of a fundamental shift in terms of how these two markets have played off each other. And to me, the message is not a positive one for the 60-40 allocation, but that's what everybody uses.
Mhm.
So to me, that's a real risk for most people because it's not going to help work as it did, in 2001 and 2008. Didn't work last year. Okay, treasury, this is technology stocks, pretty basic. In the late or early 1970s, they were known as the Nifty 50. You've owned these 50 stocks, you don't have to do anything, right? Mm-hmm. One decision stocks is what they're referred to. Well, we can see what happened in the secular bear market that took place from 1966 to 82. They didn't do so well. 2000, dot-com bubble, and where we are today. So my point is, everyone's crowded into these technology stocks. They're all great companies, but their valuation has gotten detached from the rest of the market, and I think reality. Because in 2000, I was writing, yeah, tech stocks are immune from higher rates because the Fed was raising rates back then. Mm-hmm. But when the economy goes into a recession, their customers are going to cut back on capital spending and revenue growth is going to slow. So you're paying 30 times earnings for these stocks. Why? Because growth, revenues are growing at 25, 30%. Well, what if those revenues get cut in half? They're still growing faster than everyone else. It's just the willingness to pay up for these stocks. So secular bear market to me implies that we'll see a window of time of underperformance. I mean, what happened after 66? We had a 16-year secular bear market. 2000, you had 9 years of underperformance. So again, this adds credibility to the idea of, okay, we're in a new era, and the same rules that a lot of people have used to guide them, I think, aren't going to work.
Yeah, I kind of laugh when you bring up the example of the Nifty 50 in the 70s. It's almost like the Nifty 5 now, right? And that concentration of capital and revenue in the NASDAQ, I think, is another sign of trouble within the economy.
Yes. Yeah. Well, those 7 stocks are 29% of the S&P 500. Mm-hmm. Okay. So there's a S&P unweighted index. And every stock in that, because 500 stocks, gets a weighting of 0.2. Mm-hmm. So here we have the S&P cap weighted 29%. Those 7 stocks in the equal weight have a weighting of 1.4%. Mm-hmm. And so we've seen this huge divergence.
You get a very different picture, I'm sure.
Absolutely. Big difference. So anyway, this is just another warning sign. All right. So secular bear market may have begun. What it implies is, okay, the decline to 3,500, I think could be a wave A. This rebound that we've seen is a B wave. I was looking for a rally above 4,500, maybe 4,550. We've gotten there much, much quicker than I thought. In fact, the S&P, I mean, the Qs got to, like this far away from a higher high than where they were in late July. So they could push a little bit higher. It might get the S&P up near that 4607. The bigger picture, though, is that I think we're going to see a wave C decline happen, Tom. Again, on the Wall Street being fooled by, oh, wait a second, we might actually have a recession and what that means for earnings. So I think this rally, when it completes, and it may last into December or even early next year, but I think the main message is look out below, because once this rally completes, I think the probabilities are we're going to see a fairly significant decline in the first half of next year. Valuation Buffett indicator basically takes the capitalization of stocks compared to GDP, on the idea that, hey, these companies represent value relative to GDP. And what we can see is in 1966, they got really overvalued. 2000, really overvalued. They're kind of back where they are now. It's over, the S&P, this valuation is over 60% above where it was in 2009. So to me, that's the downside risk in a secular bear market, is that we'll see another decline, more than 50%. It may take a number of years for that to take place. Probably will. But this is the risk that I don't think people fully appreciate. So what I see is a confluence of things coming together. The economy slowing next year, but then I think an extended period of slowing is going to kind of be the new normal, so to speak. And I think the next chart kind of addresses that. This is the 1966, 72 time or 82 time period. And it just shows these huge swings that we saw in the Dow. 1,000 down to 630, 1,000 down to 574, 1,000 down to 700, 1,000 down to under 800 in 82 before you finally took off. So if you buy and hold during this, which most people will do, you're not going to be real happy with the results. So to me, the message here is that if I'm right about all this stuff, Tom, people need to think about allocating some money toward tactical so that you can try to benefit from some of the swings. Look at, the last year or so, the kind of swings we've seen. You need to try to take advantage of that. And so the things I'm talking about, it's not like, oh my God, this has never happened before. Here's a fairly recent example. And this is the kind of window that we're headed toward, I think, for a number of reasons, as that piece, The Coming Secular Bear Market, discusses. I think this decline is going to wind up being worse than the 1966-82 time period. So either way, it's not going to be fun.
I mean, if we extend this chart out, very likely we're probably almost, people talk about a lost decade. This is a lost 2 decades, really. Yeah.
And I think we're, for a lot of fundamental reasons, I think that's what we're headed for. It's either already begun, bond markets have entered a secular bear market, or there may be one more last flurry in the next handful of weeks that maybe gets the S&P above 4,600. Doesn't matter. The bigger picture is what comes next. And I think the odds are we're going to see the economy slow a lot. And I think that the market's not going to like that. Okay, a couple of reasons why this is kind of higher level stuff. But when the government would do deficit spending in the 1960s, it would add about 90 cents to GDP. And that's what that trend line kind of shows, smoothing out all the squiggles up and down. Now we're down to less than 40 cents. So my point is, what we've seen over the last 40, 50 years, anytime the economy slowed or went into recession, the government ramped up fiscal spending, and that helped us get out of the recession. Well, they've had to spend more and more money to get the same effect, which means bigger and bigger deficits. And this to me suggests that the efficacy of fiscal policy has slowly but surely losing its power. So you got to use a lot more of it to get the same result. And we're at a point where already debt has gone from 20 trillion to 33 trillion, all the things we talked about before. So this is another reason why the tools that we've relied on to help goose the economy, fiscal policy is just already less effective than it has been over the last 60 years. And then the other issue is monetary policy, which the next chart I think we'll get into. So what this shows is for decades, the Fed, its primary policy tool was the funds rate. And it always was positive. In other words, the funds rate was always above inflation. So it had a real rate. The Fed would cut rates and then increase them. And that helped manage the economy very well. Then what happened in 2001? They couldn't, rates were lowered below inflation so that it had a negative real return. So that was an extra step in terms of, well, normal policy isn't working enough. Now we got to take this extra step of, in a sense, creating negative money. Mm-hmm. And then after the financial crisis, the Fed adopted quantitative easing. They expanded their balance sheet to depress long-term rates. And so to me, this suggests that monetary policy has also lost its mojo because the traditional tool, the last 20 years, the Fed didn't think was enough to spur economic activity. And they had to resort first to negative real rates and then quantitative easing. And the next chart shows the Fed's balance sheet, I believe. So in 2007, the Fed's balance sheet was 700 billion. It went to 4.5 trillion and then 8.9 trillion. And they're trying to shrink it. But again, the point here is that normal monetary policy stopped working as an effective tool. And, what that tells me is going in the next 10 to 15, 20 years, the combination of weaker fiscal policy and less effective monetary policy kind of says, wow, economic growth is likely to be less than what we've seen at a time when we have more debt and interest expenses chewing up more and more of the federal budget. Mm-hmm. So those, to me, those are things that are supportive of the idea of a secular bear market in stocks.
Mm-hmm. Yeah, I mean, when you combine that lessening efficacy of fiscal and monetary stimulus and, bringing in that component of the growing debt, the growing entitlements, I think that's a perfect way to summarize it, Jim.
Yeah. No, I mean, that's what we're facing. And then lastly, here's polarization. So we have a lot of big problems that we're facing as a country. And what we can see is the polarization was really high, relatively high going into the 1930s. Then World War II happened and it brought everybody together. Well, what we just gone through is a pandemic that killed more than 1 million people. And unfortunately, it seems that polarization increased as a result of that event. It didn't pull us together. So in Washington, we see complete and total dysfunction. Each party is more motivated by making the other party look bad than actually solving a problem. Mm-hmm. So the issue of compromise, are you kidding me? Because ideology has taken root in both parties to such an extent that they can't talk to each other. And so what that implies to me is that things will have to get so bad that they then are forced to say, you know what, we have to kind of let go of ideology and start to, kind of move toward common sense to address some of these problems. And so Social Security, they're going to have to either raise taxes or cut some of the benefits. All these problems require raising taxes, which the Republicans don't want, cutting spending, which the Democrats don't want. Mm-hmm. But the only way they'll agree to that is if things are so bad that they have to let go of their ideology and instead do what we need to do. Mm-hmm. But so to me, it's kind of like a lot of this stuff is all coming together at a time when, unfortunately, the leadership of this country is not up to the task.
So I guess that's it for the charts, hey Jim?
That's all she wrote, as they say. So again, if you want the coming secular bear market, send me an email, jimwelshmacro@gmail. If you want a copy of the slide deck, happy to send that out as well. And Tom, this has been great. I mean, it's so cool to have the opportunity to kind of talk about each of these things in some detail, and then hopefully pull them all together to create a cohesive framework for people to maybe get their arms around what's coming. So I really appreciate the opportunity to do this, and thank you.
Not a problem, Jim. I appreciate the conversation and the way you laid everything out, and having the ability to, like we said, take the time to really inspect and go through the finer minutia of what's happening here, and maybe some of the reasons that we have some of these artifacts in the data, like this growth in the GDP, or whatever that may be.
Yep.
I think the marginal utility of debt growth is another perfect example of that, right?
Yeah, it really is. And again, it's sometimes you have to step back, and to kind of put things into context. And to me, some of those charts in terms of the efficacy of fiscal policy and monetary policy, those are big deals, because that's how we've confronted every recession since the late 70s. And if those tools aren't as effective, well, there's implications of that. So, no, I hope people take us up on getting the special report, and if they have questions, please, I'm more than happy to answer them. I think the next handful of years are going to be very dynamic. And, I'm doing my best to try to keep people ahead of the curve.
Well, I am too. And I appreciate you coming on to help share that with us, Jim.
My pleasure.
Of course, your website again, macrotides.com, on Twitter @Jim Welsh Macro, and of course, LinkedIn as well, Jim Welsh, right?
You got it.
Perfect. Jim, thanks so much for your time today.
All right. Stay well.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.